Okay, good morning everybody and welcome to Tvfcu's, our live homebuyer seminar. I'm Eric Weekly, Vice President of Mortgage Lending for Tennessee Valley Federal Credit Union, and with me today is...
I'm Brian Fryer. I'm the sales manager in the real estate department, mortgage department.
So again, welcome everybody, and we hope you enjoy the seminar. And so today we're going to talk a little bit about what it's like to go through the home buying process and what you should expect. We got some questions here from some of our guests that have logged on to watch the presentation here. So we'll get to some of those questions later on in the session here. But we kind of wanted to start out and go over just kind of some of the basics. So first question, what kind of mortgage should you expect, or how do you know what type of mortgage is correct? And so Brian, I would say, obviously you got to start out with your budget and know what you can afford. Because then we can help you cater a product to those payments, to how much you can afford, and also really to make you feel comfortable in the decision to buy a home, or even if you're refinancing a current mortgage, whether or not you want to shorten your term, or you want to lengthen that term a little bit to relieve some payment, or if it's cash out for debt consolidation or home improvement, whatever. We've got a lot of different options that we can provide as a lender, to kind of help ease your mind about what type of mortgage you should get.
And also, I kind of add too, doing the budgeting part too, this is part of it. You want to look and see what your goals are in the future. Where are you going to be 2 years, 5 years, 10, 30 years from now? So that's a big part of the budgeting process.
It is. It's very important to know, what you're comfortable with now may not be the case in a few years. It could be better, it could be worse. But kind of plan for now and then, but also look at those long-term goals, like Brian was saying. So Brian, as far as mortgage types, we have fixed rate, we have adjustable rate, we have HELOC, we have all kinds of products that we can provide members.
All kinds.
So give us a little example, the difference between an ARM and a fixed rate.
What you're looking at on an ARM or fixed rate. Fixed rate means for the term of the loan, whether that loan is 5 years, 10, 15, 20, 30, 24 years. A fixed rate loan, that interest rate is fixed for the term of the loan, for the entire, and it is fully amortized. You will pay that payment each month, and it'll pay that loan off. Say for a 30-year loan that's 360 months, you make that payment each month. It will pay off that loan at that fixed rate. So that rate will never change. Your principal and interest payment will never change. Now, if you have escrow, your escrows can change. Your taxes and insurance, those can go up or down. Most chances they'll go up. Usually, property taxes, homeowners insurance. On an ARM loan, what an ARM loan is going to be, it's called an adjustable rate mortgage, ARM. Those can be fixed for a short term, like an introductory rate. Sometimes your ARMs can be 7 years, 10 years, but it's a 30-year loan or a 20-year loan. But for the fixed period, it can be a fixed rate for that term period. And the advantage of those of ARMs, especially those that are fixed for a short term, is you take advantage of a lower interest rate. Now, ARMs, I always tell people, ARMs are geared for a specific type of borrower. Generally on ARMs, sometimes you're looking at trying to pay as much towards principal as quickly as possible because you're taking advantage of that lower interest rate. And a lot of people that get ARMs, like on a 7-1 ARM, which is a 7-year fix, but it adjusts after that 7-year period, are people that know they're not going to be in that home more than 7 years. So, or looking maybe to refinance it within that time. So ARMs have gotten a bad rap in the past, but ARMs are a good vehicle to pay as much as to the principal as possible when you're taking advantage of that super low interest rate.
That's absolutely correct, Brian. And the advantage of the ARM, again, as Brian was stating, is you can pay a little bit more towards your principal each month because generally the rates are a little bit lower. And I always tell members and borrowers and consumers, don't be afraid of an ARM product just because it does adjust. We have options for that when that adjustment rate period comes up. But again, think about long term. Do most people stay in that mortgage for more than 4, 5, or 6 years? And the answer to that is really no. Your average weighted term of a loan for most people is about 4 to 5 years. Especially if you're a first-time home buyer, you might be looking to upgrade in 4, 5, or 6 years. You don't know if your family changes, you've added to your family, or you're moving to a different area because of a job change or something like that. So take advantage of those lower rates and those options to build more equity in your home.
They're, like I said, ARMs, they are, when I'm especially talking to first-time home buyers, if their credit may not be, as stellar or top, sometimes they can take advantage of the lower interest rate on the ARM. So it is a good option. Great option.
Okay. So Brian, does somebody have to be a member of Tvfcu to be able to get a loan?
They do. We cover a 13-county region. In order to do a loan with Tvfcu, you do have to become a member. You have to live, work, worship, go to school, volunteer in our 13-county region, or be blood related to a member currently. So generally, I tell everybody, especially if you're in our area, North Georgia, Southeast Tennessee, we can pretty much make everyone a member for the most part.
Yeah, and that's the advantage of the credit union. You know, you do have the membership hurdle to overcome, but once you're there, you have the access to all of our products, not just our mortgage loans, but our consumer loans, boat loans, credit cards, our fabulous checking accounts, savings accounts, and again, credit union, we're here to help people. So
We are.
All right, so Brian, where does somebody begin to buy a house? What are the first steps they should take, and then kind of take it from there?
And this is what I always tell people. You know, you may have a realtor, you may not. I always tell everyone, you want to go ahead and get pre-qualified. Very, very important. Because you want to know what you can afford, what you can qualify for, what your payment's going to be, your interest rate, and everything like that, or roundabout what your interest rate would be. Because also, especially in today's market, if you're going to make an offer with a seller, they'll want to make sure that you're serious and that you have something from your lender in writing that says, hey, we've looked at this person, we've looked at their credit, we've looked at their scenario, and we can do a loan for them. We have pre-qualified this person, so very, very important.
It's pretty much a mandatory thing now. Most agents won't show a home or even entertain the thought of showing a home without knowing whether or not somebody can really afford that particular house. I could walk out on the street and say, I want to look at a $10 million house knowing I can't afford it. So the agent's not going to take their time and waste your time as well.
Time is money, and especially in this market today, I think everybody has seen in the news, Chattanooga area and all over the United States, the housing market is very tight, very tight. So sellers want to make sure, and realtors want to make sure you are serious about buying.
Yes. So getting pre-qualified for a loan before going to look at a house is a crucial first step. And knowing what your budget is, applying for the loan, knowing what you can and can't afford, because there are a lot of different factors that play into that. And then, getting that pre-qualification letter to take to your realtor and say, hey, I'm ready to go start looking at homes. What else? Are we missing anything there?
I would also, if you're looking at getting pre-qualified and just perchance you can't get pre-qualified, especially here at TVFCU, our people, our loan officers, our originators are going to let you know where you need to be to get pre-qualified in the future, hopefully. Because sometimes, it may not be the right time for you. Credit may not be up to what you would like to qualify, type of program you want to qualify for. We can help you get to the steps to where you need to be maybe 6 months, 12 months down the road to where you can get pre-qualified. But pre-qualification, super important. Also, once you get pre-qualified, you want to make sure that you don't make any changes in your income, your job status, your credit. If you have money you're going to be putting down, make sure you're not going through that money. You want to make sure that scenario that you've gotten pre-qualified for stays true through the loan process, etc.
Right. So all good points there, Brian, as far as purchasing a home. And, in a normal market, the typical process, once a home is found and a contract is fully executed, is 30 to 45 days would be standard. We're kind of in a little bit different of a time frame now because rates are so low. There's not a lot of inventory in our market here. And I would say a healthy market would have 6 to 8 months worth of housing supply.
Traditionally,
right around 30 days worth of housing supply.
30 days,
So, finding a house can be a daunting task, and then actually going through the process. We hear from some of our competitors, because our members are coming to us saying, well, it was taking 90 to 120 days at another lender.
Yes.
And so I would say, right now we're averaging about 30 to 45 days, depending on the situation, and all of the external factors that play into that, your title work, your appraisal, things like that. And even for refinances, if you own a home currently, it's about the same time frame. So, don't let the fact that it may take a little bit longer deter you from buying a home or even refinancing. There's no better time than now to do so.
Rates historically low. Fantastic time to refinance.
And speaking of interest rates, Brian, what kind of, I know we said they're historically low, but what does that look like?
Wow. We're looking, as far as rates going, you're looking at upper to mid twos in some chances. Fixed rates. I've been in business 23 years, and I've seen some low rate times back in 2011, 12, working around that time period where we had some historically low rates. right now, we're looking even lower now. Ever since March or so, they've been low. From all what we've heard, they're going to stay low. They may go up a little bit in 2021, but still historically low.
Yeah, anything's better than 5, 6, 7, or even 15 or 16%.
Yeah. Eric knows, and we've talked about this many times. Back in the day, you were getting 8, 9%. You were doing pretty good.
Yes.
And now you're, a third of that.
Right.
If not less sometimes.
Yeah. So another question that comes up in the home buying process is, how much money do I have to have for a down payment, or how much money should I just have in general? So, we have a lot of different options here at the credit union for 0 down all the way up to, a lot of money down. So the credit union does provide some 100% financing options where you might have to have a little bit of money for some closing costs or some incidentals, your insurance or something like that. But we can accommodate also 3% down, 5% down, 10%, 20+% down. But every situation and every scenario is going to be a little bit different. So maybe not necessarily how much you have to have saved or how much you have to have for down payment is, tell us what your budget looks like, tell us what you're comfortable with, and let us help you kind of work those numbers together and see, okay, well, if we can't do, say, this 100% financing, maybe we can do something with 3% down.
There are all kinds of avenues as far as like down payment money, and there can be gifts from a relative that you can do for down payment. And Eric was talking about the 100% product, which is something we're known for here at the credit union. It is a great product. We have a lot of members that do have the money to put down, but they choose to do the 100% product just because they want to keep that money in reserve, maybe for a rainy day or something like that.
There's absolutely nothing wrong with the 100% product. Or putting no money down. I know a lot of times, the amortization period that we offer will help build that equity faster. So, you are saving your money for a rainy day. You got your rainy day fund, or maybe you've got an unexpected expense like your refrigerator goes out, or your air conditioning unit goes out, or you've got to, put new tires on the car. So then you've got your money that you saved still in savings account, hopefully with us. And, that you can use for that. But also, again, you're building that equity in your home with a little bit shorter term. And so, I wouldn't be, have anybody be deterred by the fact that, well, you're not putting any money down, you don't have any equity. You're going to build equity through your payments.
And then hopefully you're paying down the principal, and the house is building in value. So that's something, that gap right there, that's your equity right there that you're looking at. So very important, very, very important.
So along the lines of the down payment, we talked about 0% down, 3%, 5%, 10%, 20%. So another factor that plays into the loans, Brian, is the PMI, or the private mortgage insurance.
Yes.
So anything that's less than a 20% down payment typically would have PMI.
Yes, it would.
So on some of our loans that we offer here at the credit union, we don't charge that private mortgage insurance. So what would be the benefit to that?
Yeah, the benefit to not having the private mortgage insurance, private mortgage insurance is a monthly payment. It's added on like your tax and insurance escrow would be. So that's going to increase your payment. You may have a lower interest rate on that loan product, but then you didn't put the 20% down, you're going to have that monthly PMI, which eventually does drop off after a certain amount of equity in a home over a period of time. It will drop off automatically. However, you are paying that each month, so that's something to think about. As far as your budget, you want to look, hey, if I'm not putting 20% down and I want to go for this product, I'm going to have this additional increase in my payment. So that's something you want to look at. With the 100% product that we offer, we do not have that. So that's something, you definitely want to look at, because I know a lot of people are payment sensitive. Interest rate is important. Payment also is very important to borrowers. You got to know what you can afford, what you know you're going to be paying each month. So that PMI does come into play, because sometimes it can be very expensive.
And on your conventional 15, 20, and 30-year products, the PMI, that private mortgage insurance, it varies based on how much is paid down, or 3%, 5%, 10% down, or more, as well as on a refinance, depending on what the value of your home is in comparison to your loan amount. So those factors are a little bit different, and so the PMI could be a little bit cheaper with more money down or a little bit more equity in the property. And kind of like interest rates right now, the rates for the private mortgage insurance are really, really low, so it's very affordable. I mean, I've seen PMI payments of $300 and $400 and $500 a month, whereas now we might see $60 or $70 or $80 a month. So just because a loan might have a little bit of PMI on it, doesn't make it a bad loan.
No,
It doesn't
not at
mean
all.
that,
Not at all.
it's not worth paying.
Yeah.
But
Exactly, and eventually it does come off. It will come off the loan.
yes, yeah, there are ways to either get out of it completely or have it fall off your loan. And we could get into more details about that, because every scenario or every loan type is gonna be a little bit different, yes.
Yeah.
So,
It's always good to look at all your options.
Yeah. so we've talked about how much money's down and, the PMI aspects, and so kind of into like the job and the income portion of the qualifying. I know a lot of questions come up, well, how long do I have to be on my job? I just started a new job, or I'm starting a new job, I'm fresh out of college. So kind of walk us through a little bit of that, if you will.
Yeah, and then this also too, I'm gonna put another point in there too. If you're looking at refinancing, purchasing, make sure you're staying at your job, especially during the loan process. If you're looking at changing jobs or careers, do talk to your loan officer, originator, before you do that, because it could impact your approval on your loan. So it's a big deal. Please keep that in mind. But as far as being at your job, generally 2 years plus is what we like. But there are instances where people do change jobs. We have people that work for say you're an electrician and you work for a company and you receive a W-2 from them, you get a paycheck, you decide to go to another electrical company. So and that you could be at that job less than 2 years. So that's something that we will look at.
Yes.
My job, I've only been in my new job 2 weeks. So do let them know that, okay? Just because we need to see where we can put you in the type of loan program and make sure we can get you qualified.
Yeah, and even for college students or somebody moving from out of state who hasn't really started a job yet, you're moving from one state to another. It's a different market. It's a different, kind of an atmosphere, whatnot. So if you're starting a new job, we can work with members, consumers, borrowers, buyers.
Exactly.
And it's simple for us to do, especially if you're even out of college and you've not had a job. Maybe you've had some part-time jobs, make your way through college and whatnot. We can still accommodate those requests in most cases. We verify that the employer has hired you. We get a first pay stub, and we kind of have to determine what the likelihood of that employment is, to continue.
Correct.
So it just because you're fresh out of college or you're just moving here doesn't mean you cannot get a loan.
Yeah.
That's where we're going to talk with you throughout the process and make sure that you can afford the house and and we're making the loan right for you.
We see that quite a bit. Come along summertime, a lot of college graduates graduate in the spring and they've gotten their new job. They're starting to make a good income and everything, and they're looking at getting out of that apartment and looking at purchasing a home. So don't let that deter you if you're a recent college graduate.
Right. Exactly. Yeah. Come and talk to us.
Yeah.
So something that we have faced obviously this year has been the pandemic, and we have experienced some job losses and some business closures and things like that in our marketplace and across the entire country here. So if somebody has lost a job and they've started a new job, maybe not even in the same profession, can they get a loan?
They can. And again, that's communication is the key. Letting your originator know at the beginning of the process, hey, this is something that, I lost my job, I was working at so-and-so due to the pandemic, I did find another job, it is in a different career field, or do let them know that, this is what I was doing before, this is what I'm doing now, this is how long I've been there. But yeah, we were looking at that quite a bit, and we have loan programs, that we can put you in that you'll qualify for. That's definitely something that's taken into consideration too. And one thing I'll add too here, and Eric, will back me up on this, is being a local credit union, all our decisions are made locally. Our underwriters are here downtown Chattanooga.
Yeah.
So
in an undisclosed location.
Undisclosed location. But all decisions are made here. So local underwriting. So we have the ability to look at these loans on a case by case basis.
And so, Brian, what about self-employed borrowers?
Yeah, self-employed borrowers, this does come up quite a bit. My father was self-employed for over 30 years. Self-employed borrowers, you do want to have a 2-year history of self-employment with income documents to back that up. We want the 2 years tax returns showing that self-employment. And Eric, you may want to go into this a little more detail, but I know with a lot of self-employed borrowers, the way you do your taxes may not always show some of your income. So Eric, you want to expound on that a little bit?
So nobody really likes to pay taxes. We'll just go ahead and admit that. And so historically, you know, if you're self-employed, you find what we call write-offs, and your accountant or your CPA, unless you're doing it yourself, will kind of help you with some of the expenses that the IRS allows for that. So a lot of times we would see that there really wasn't enough income there to qualify.
Yeah.
So, and some of the changes that have come in the mortgage industry over the last almost 10 years now, really, have kind of really crimped that a little bit for some self-employed borrowers who have to show a little bit more money to qualify for mortgages.
Yeah.
So just because you've been self-employed for 12 months or 18 months or 20 months, not quite the 2 years, doesn't mean we won't look at the scenario or the situation that you're in and see if there's a way we can make something work for it. But we do take a good hard look at that income to make sure that you can afford what you're buying or what you're refinancing. And also to make sure that, you know, a couple years down the road that we expect this kind of income to maintain.
Yeah.
You know, obviously we have rules and regulations that we have to follow as a lending institution, but we like to take a look at that from a holistic approach and see, okay, how can we make something work here for this member or help this new member, you know, either get into a home that they really, really are wanting or needing, or, you know, because of, you know, family size growth or whatnot, or, you know, if they've got a current mortgage, how can maybe we relieve payments, or maybe they're doing really great with their business and they want to get their house paid off faster and they want to actually be the homeowner versus having their lender be the note holder.
Yeah.
So.
And that also goes into play when Eric's talking about the loan programs. You know, some are more restrictive than others. So we have programs, you know, where we can look at, we have a little more leeway in what we can do sometimes.
So being self-employed, you know, most members and borrowers have, you know, a business account or something, maybe hopefully for us again.
Yes.
You know, so what would we be looking for on those bank statements in a qualifying application?
Yeah, we're looking at, you know, of course, on the tax returns, we're going to be looking at the net income after, and there are some things that we can add back in, depreciation, stuff like that. And that's where your originator is going to do an income analysis with your tax returns. Of course, the underwriter is going to do the underwriting analysis of it too. But you can have a first look and just see what, you know, where you stand as far as income goes. Very important though, if you are self-employed, it's something you do want to let your originator know. That way, you know, they can further that conversation on, ask a few more questions. So,
right. And somebody who owns a number of properties, rental properties.
Yes.
That's also considered kind of like self-employed income. So, so what would we be looking for from that aspect?
Well, we would need to see the tax returns that show where those incomes are income-producing properties, or if there are any losses on those properties as well. Also, sometimes in some cases we can use lease agreements. In some cases, again, that's going to go back to the type of loan program that we're looking at. But yeah, we have all kinds of outlets. We have a lot of people that are landlords and own multiple properties. Sometimes they own them free and clear. I will say, if there are no mortgages on it, we still do have to count the taxes and the property taxes and the insurance on those two. So, because that is a debt that has to be counted as well. So, but yes, we also do investment properties too. If somebody wants to buy a duplex to rent out, or if they want to live on one side and rent out the other side, we have loan programs for those as well.
The way I approach things is I like to look at everything.
Everything.
I like to look at it.
We like to look at it.
So let's say you buy a house 6 months ago. Can I refinance it now?
You can. Actually, you can. Now, depending on the loan program, of course, depending on what you want to do, refinance, cash out, in almost any instance, you've owned it at least 6 months, we can do a loan for you. Cash out refinance, no cash out refinance. If you just bought it yesterday, we can look at doing a refinance on it as well. There's no problem with that. Again, we want to look at everything. So, because some people, you know, buy a home and they automatically have equity in the home. They put a large down payment down on it.
Yeah, we can even provide a home equity line of credit.
Home equity line of credit.
We can do that pretty quickly. It's very inexpensive. And like the example you gave, somebody puts a lot of money down. Then they're just basically getting their money back.
They're recouping that money, or they want to have that line of credit available just in case an emergency comes up. I'm a big fan of line of credits. It does take a little bit of discipline. You have that $50,000, $20,000 line of credit. You have it. You may not have a balance on it. You don't pay a monthly payment. You don't pay any interest on it if you don't have a balance. But it's there if you need it. It's there if you need it.
So another question that will come up sometimes is when you're applying for a loan and maybe you can't qualify for the exact amount that you want. Maybe you've got this perfect house in mind,
Mm-hmm.
but it's just a little bit above, or maybe a lot above, your price range and your budget. Can you use a co-borrower or a sibling or a parent or fiance or
Yeah, depending on the loan program, again, you can use a non-occupying co-borrower, they say. So, that's allowable.
How many borrowers can be on a loan at one time?
Up to 8.
Up to 8?
8 currently. Up to 8.
You can allow up to 8 people on
They
a loan.
can allow up to 8 currently. So, quite a bit.
All right, so let's kind of transition a little bit into, we've talked about, the application and, looking for a home and your budget and whatnot. Let's talk about credit. Credit's a big factor in buying a home and or refinancing or the home equity line of credit or whatever it may be. So what can somebody expect from a credit standpoint, and how can they monitor their scores or know what they're getting into?
Yeah, and credit, it's, I always get this asked the question when before COVID, I do seminars and talk to people. Credit is a mystery to a lot of people.
Mm-hmm.
What goes into your credit and what affects your credit. That's a whole different class almost right there. Basically, you make your monthly payments, whether it be an installment loan or revolving credit. Revolving credit can be credit cards. Installment loan can be a car loan, a signature loan, a mortgage payment. So those are what get reported on the credit bureau. You want to make sure you're making your monthly payments every month. You don't want to go 30 days late, 60 days late, or 90 days late. Those can definitely negatively affect your credit. Also, you can on your credit you will have any collections, any charge-offs, anything like that, anything negative on there. But as far as credit goes, there are 3 credit bureau providers currently: Equifax, TransUnion, Experian. In the mortgage industry, what we do generally for a first or second mortgage, we pull all 3 credit bureaus.
Mm-hmm.
We're going to pull all 3 of them: Equifax, TransUnion, Experian. That way we get a whole picture of your credit, what's going on, and that's going to be for both borrowers too. We're going to pull credit report on all 3 bureaus on both borrowers, and then we're going to take the middle credit score and use those for the qualification and interest rate qualifications as well. Generally, they will take the lowest of the middle score of the 2 borrowers. I will say, home equity lines of credit, currently we just use 1 credit bureau when we pull Equifax. So just a little bit of word there. Credit is, it can be a little bit of a mystery. Some people can not use any credit at all, but have had good credit in the past, but their credit scores aren't quite very high.
Mm-hmm.
It's because they haven't accessed credit.
Mm-hmm.
It's unfortunate. I know a lot of people are cash people. I pay by cash. My dad was a cash guy. So, you do have to access credit and pay good to have those credit scores higher and everything. But again, we have loan programs for any kind of situation. We're going to look at, when we pull someone's credit, we're going to look at the overall situation too.
And that's a great point. And what I was going to say, Brian, is when you go through the application process, our mortgage loan officers are going to talk with you after pulling your credit, and we're going to go over that information with you. And some people know they have excellent credit, some people know they don't have such excellent credit. But we're going to talk through those products and programs that we can offer, or how we can help get you to a point where you can afford, and from a credit perspective, be qualified to purchase a home or refinance. So again, it's kind of, well, you got to have excellent credit. I've got to have a 740 or 760 or 780 or an 800 credit score. Well, not always. We look at every scenario, and we can, in most cases, do most loans at 620 or higher. And some of our loans that we offer here will go even lower. So while credit is a piece of it, it's not the overall determining factor. There's a lot of things that play.
There's a lot that goes into it, and like Eric was saying too, someone may not have very low credit, but not the highest to qualify for like the best rate or the best terms. We can look at it and see if we can give you some hints or tips, which you can do 6 months down the road maybe to, hey, you need to take care of this collection or clear up something that's on your credit reports and get those cleared up. And then a few months down the road, maybe you could qualify for that better rate and those better terms. So sometimes it right now may not be the optimum time for you to do that refinance or that purchase. You may have a little work to have to do on that credit to get those best terms.
Right, and in a situation like that, where maybe you don't have a 740 or an 800 credit score, but it's something that we can work with. We may be able to offer one of our ARM products or one of our other lending products that we have available to us kind of as a short-term, you know, hey, you know, we're going to help you work through this, and we're going to work with you to build your scores up.
Yeah.
And so maybe in a year or 2 or 3, we revisit it and see if we can get you into a better overall product.
We've done several like that where they qualified, their scores weren't the top tier, but we still qualify them for a loan. They may have had limited credit, you know, the first time home buyers, just, you know, younger, out of college or out of school and just starting their job. They just haven't borrowed a whole lot. And then we get them in the home, and then when it comes to credit, you know, the top of that tier is that mortgage payment. And I'll tell you what, you make that mortgage payment on time, you kept all your other credit clean, over a few months, your credit scores are gonna be up there. They're gonna be good. They're gonna, that making that mortgage payment is very, very important as far as establishing credit.
And again, just because you don't have excellent credit, in terminology speaking, doesn't mean we won't look at something and work with you.
Exactly.
So Brandon, let's kind of recap a little bit. First, figure out your budget.
Figure your budget.
Yep. Second, come talk to us, apply for the loan, let us look at your credit, and kind of set up that payment structure and assist you. We're not going to make the decision for you, obviously.
No.
We're going to assist you in deciding what term, what rate, you know, that kind of stuff, you know, all plays into it on what you can afford based on your budget. Go find a house, get your pre-qualification letter, get to your agent, find a house, and then get back to us to start the process. And then process takes 30, 40, 45 days, something like that. We do all the work on the back end once we have our disclosure signed. We do title work and appraisal work, and we basically do all the legwork from there. And then we get you to closing, and then you get the keys to your house. So, what do we miss?
Just to expand on what Eric's saying, you know, the process can take 30 to 45 days generally. Also, too, to let everyone know, you know, you do go to a closing and you do close your documents. Generally, on a purchase, once you close that loan, it's a done deal once you sign all paperwork. If you're refinancing, there is a 3-day waiting period from the closing date till the term that it goes into effect. That is called a rescission period. So just let you know, the government has put into effect, this is many, many years ago, that rescission period to give you time to look over those documents for 3 days since you are refinancing your house. The only exception is if you own an investment property or rental property, there is no rescission period on that too. So that's something just want everybody to know. If you are looking at refinancing and you're wanting to get cash out for a specific project you're wanting to do, please make sure, let your originator know that you're going to need that money in a certain time period, because once you go to closing, that money won't become available for at least another 3 days, or so, 3 to 4 days. So just keep that in mind, and again, communication is always key. You know, letting your originator know what your goals are, what you're wanting to do. You know, you're wanting to purchase this house and you're going to live there for 3 to 4 years, but you may move out later on. Again, we talked about the ARM product. That may be the way to go, to be honest with you. If you're looking at refinancing for cash out to build a pool and you've got a contractor that has a date they're going to start on that pool, let your originator know. We need to know that up front, and that way we can kind of know what we're up against.
Okay. And as far as the pre-qualification, you know, in today's market with a limited housing supply, it may take a while to find a house.
Yes.
So that's usually good for about 60 or 90 days. Maybe go out a little bit further if we need to, but we'll have to refresh some documents or maybe look at the credit again after that point in time. But applying for credit is really not going to hurt your overall credit score.
No.
You might see a point or two drop here and there, but you know, the regulations that we're under kind of help prevent drastic decreases in credit scores if you shop with us, or if you've looked somewhere else and you didn't like what was offered there, or somebody couldn't do something for you, and you come to us and we can. So whereas on the flip side, on a consumer loan, if you're going to 15 different car dealerships, and they pull your credit, and you're going to see a drastic decrease in your credit score.
Correct.
So, you know, that pre-qualification is usually good, again, for 60, 90, 120 days, you know, kind of out there a little bit in the future, because we understand that you may look at 50 houses if 50 are available, before you find the one that, you know, you want to make the offer on. And then again, throughout that process, once the offer is made and accepted by the seller, we work with your agent on getting all of the contracts in place and all that. So we go through that whole process before we get you to closing.
And like Eric said, that letter that we get you, if you're pre-qualified with Tvfcu, we give you a letter on our letterhead that is dated and signed by us. So that letter you can use with your realtors and sellers to let them know that you're serious. It is in black and white. We have pre-qualified you. We have looked at your loan scenario. We've looked at your credit, we've looked at your application. After that, you know, and you've made your offer with your letter and everything, you'll sign a contract. Once you've signed a contract, you want to get that contract to us as quickly as possible so we can begin the actual loan process.
Right.
Okay?
So we've gone over a lot, Brian, and I know some of our viewers had posed some questions prior to us going live. So we want to kind of touch on a few of those.
Sure.
And one of the questions that came through was, does pre-qualifying cost money? No, it absolutely does not. There's no cost until we actually get into the loan. And in most cases right now, there's no cost until the very end, other than earnest money if you're buying a house, but that's with the realtors and the sellers.
Yeah.
But to come to Tvfcu and apply for a loan and help us, or have us help you structure your loan, does not cost a penny.
Doesn't cost you anything.
Doesn't cost a thing. We're not going to take a credit card for your credit report or anything like that. That's a cost of doing business that we're absorbing, and again, really nothing until closing.
Yeah, and that's actually, you know, one of the specials we're running right now. We pay for your credit report and we pay for your appraisal. So that's one of the many advantages coming to Tvfcu.
And so another question that was posed by our audience is, what is involved in getting pre-approved for a loan? And we kind of touched on it throughout this whole process, but again, it's come to us, call us, apply online, get the application started so that we can have that conversation with you and talk about the credit and your income and your assets, what your budget's like, what's your payment, you know, where you want your payment to be, and then let us explain all of the options that we have for you.
Yeah. And again, it doesn't cost anything to talk to somebody, you know, and if you want to get pre-qualified, you know, go ahead and you can apply online, you can call and apply that way. Definitely just get in contact with us.
And we touched a second ago on does pre-qualifying affect your credit score? That was another question that was posed.
Yeah.
And anytime you have your credit run, it's called an inquiry, it's going to factor in some way. If it's done multiple times, yes, it's going to affect credit scores a little bit, but you're not going to see a drastic decrease overnight in your credit scores. It's because you've applied for a mortgage here and maybe a mortgage there.
Yeah. Generally, I see maybe 1-2 points at the most. It is a negligible effect.
Right. And does pre-qualifying lock you into a loan or a mortgage? I would say absolutely not.
No.
Again, there's no cost, so we're not charging anything, so you don't kind of have that hook or whatever, you know, as some institutions might try to do. Say, oh, well, we're going to charge you a $500 application fee, but we're going to credit that back to you once you get to closing with us. We don't play any gimmicks like that.
Yeah.
But maybe you start out wanting a fixed rate, and then you determine, oh, well, you know, the ARM product is better for me, or vice versa. I start out with the ARM product, and then I want to flip to a fixed rate product. There's absolutely nothing that locks you in. We advise, you're in control.
Yes. Yeah. Definitely.
Another question that came through was, what type of first-time home buyer programs are there? I think we touched on our 100% product that we offer.
Yes.
Fannie Mae and Freddie Mac, which are the agencies that provide the financing avenue for these low-rate loans, have products that are 3% down, 5% down, a home-ready product and a home possible product. You might hear the acronyms FHA, which is the Federal Housing Agency or Authority. You know, 3.5% down. It has PMI. There's life of the loan PMI. There's a funding fee. So we can look at. We don't offer the government loans at this time, but we have alternative products that will compete directly with them.
The home possible product, we have that.
That's a very good product.
Very good product
for first-time home buyers.
Yeah.
3% down. It can be a gift from a family member or some sort of relative, as long as it can be documented. And again, the 100% product that we offer.
And for that home possible product, when you're talking to your originator, there is a class you do have to take. People are like, oh, I don't have to take a class. Everyone I've talked to that took that class said they were glad they took that class.
Yes, it is very helpful.
It is very helpful, very helpful. And I had a friend of mine that was like, oh, I don't want to take that class. Took the class, like, you know what? I learned a lot. It was actually very good. So just keep that in mind if you're talking to a originator, maybe look at Home Possible, and they say you do have to take a class, and you get a certificate for that class in order to qualify for the loan. It is a good class. It's very informative.
And then one of the last questions that we received, Brian, was about property types. We have single-family homes, which is your standard detached home. We've got townhomes, which may be attached or detached, and then condos. We have manufactured homes. We have modular homes. So we can typically lend on just about anything.
We can. Yeah.
There are certain criteria that we have to follow for condos and different things and manufactured homes as far as ages and things like that. But there's not a lot of difference between the products. Some may require a little bit more down as far as a down payment. Some may have a little bit different interest rates. But for the most part, buying a townhome versus a single family home is not much different. And we can accommodate pretty much every request.
And if you're looking at some property that doesn't have a home on it, we call them unimproved property, land loans, we call those. We do those here at Tvfcu. So that's something that people, and I've found, been talking to people the past couple of years when the housing market being so tight, they can't find a home and they have run out of options. Sometimes they found land. Oh, go ahead and buy the land, and save it for maybe building later, or just keep it as an investment. Because land, one thing about land, property, it rarely, almost never decreases in value. So that is an option too for some people. If they just haven't found their dream home, they're going to keep looking. But in the meantime, they found this $40,000, $50,000, $60,000 piece of unapproved property. We do those loans too.
And it's a great investment, if you are looking to build a home or your dream home. These are the plans that I have, and this is what I want to do. We can accommodate those requests as well. And if you own a home and you have equity, we can provide a second mortgage to remodel or buy a car, pay for college or a wedding or something like that. Same way with a home equity line of credit. Those can be established pretty easily and pretty quickly. To get some of that equity into your hands there, for whatever life event maybe, or maybe you want to, take a vacation or something.
One thing we haven't touched on, jumbos.
Jumbo
loans. We do jumbo loans here at the credit union. You'll hear that term jumbo, and jumbo is a larger loan amount loan. It's just recently changed.
$538,450 or some number like that.
As of January 1st. So it has increased more, in the past 2-3 years?
4 increases the last 4 years.
4 years, yes. So they definitely, jumbos, values of property gone up, so they've increased jumbos too. We do those loans here too. So we're very competitive with our jumbo product. So if you've got someone, or if you've talked to another lender, we definitely would like to talk to you. I think you'll find that we can be very, very competitive.
Yes.
Very.
Those 5 and 6 and 7 and $800 and $1 million purchases, we have a great avenue to finance those. And like I said earlier, we do everything right here. So I think I just gave away the undisclosed location. But anyways, Brian, we're kind of wrapping this thing up here and at the end of our time, and so we want to thank everybody for joining us again.
Yes, thank you.
And if you will, Brian, tell everybody how they can get in touch with us.
You can go to tvfcu.com and apply with us or inquire with us. You can also call us at 423-634-3667, and that is to the mortgage department at TVFCU.
So again, thank you for your time and joining us today, and we look forward to being of service to you in the future.